Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today's Tuesday, June 30, 2015. We're looking at a daily chart of the SPY, and I've updated the chart a little bit based on, the recent moves. So I took away some lines and I put in some new and fresh ones, and I'm going to explain what those are and where they come from and what we do with them. So, by the way, these I did not adjust up here, and I will. I just didn't do it before this video, but they're not important right now, so we'll just ignore them for the time being. But I'm going to tell you what the important stuff is. And you'll notice a new line. It's a trend line that comes right here. And basically what this is doing is it's pointing out a head and shoulders pattern that is in the process of playing out. And let me explain that. So here's your left shoulder, here's your head, and here's your right shoulder. And the reason why I didn't bring this up before is quite simple, because up until yesterday, we weren't coming into this trend line. Had we come into this trend line normally, what would normally happen is the market would come and it would kind of fight this trend line for a little while, whether it was a couple of days or longer, or whatever it is. And we just jumped right over it, or under it, I should say, yesterday, and then just fell out of bed. So that's my bad. I apologize for not pointing that out earlier, but nevertheless, we knew where the supports were, right? We knew that it was going to be the 200 if this didn't hold, and we also knew that underneath that 204.50 was support. Now, the target for the head and shoulders, and now I'm going to also explain how to come up with the target for those of you who don't know or don't remember. The target for the head and shoulders is right around 202, maybe 201. The targets on the head and shoulders don't necessarily always play out to the penny, but they get pretty close. So the way it works is you take the high point, okay, and the high point, we'll call it 213.78, okay, and then you take the point in which, whoops, I didn't mean to do that. You take the point in which the neckline crosses, okay, so we're going to call this about, let's call it 207 and a quarter, okay. So just rounding numbers, you have almost about 7 points that you would subtract from the point of this neckline, which brings us down to about 200. Okay, so it's somewhere in between, and the reason I brought up 202 before, I'll explain that in a second. So it's somewhere in between this area here, beneath 202 and 200. And the reason why I had this 202 in, because it was from a different calculation, not having anything to do with the head and shoulders whatsoever. So what I want you to do is be aware that if this did play out, and now let's talk about tomorrow, okay? You've got three options for tomorrow. You always have three options every day. We could do nothing, we can go up, or we can go down. But what tomorrow will bring, or any subsequent day, is either, and based on today's close, it was somewhat neutral to today, which was on the E-mini contract. Let's just go over there for a second. And I've done some of the work in the E-mini and did some of the same stuff. And I'm going to take this out too, because this is no longer valid. It's over. It played out or didn't play out. The E-mini contract, the close today that was important was 2054. Now we closed slightly above it, but not enough to be meaningful. And so therefore I'm going to call it somewhat of a neutral close. And what happens is any close above and subsequent trading above 2054 would normally produce, under normal market conditions, a move back up to about 2075. And you'll notice that the first line here, this first purple trend line, is 2076. So you can see where that begins to make sense. And if we did get a open above this trend line tomorrow, this head and shoulders trend line, this upsloping trend line, then that would produce a move to 2076. And I'm not saying that's it, meaning that's all. It's just that's the first or initial target that I have. Now, what's more important is that these head and shoulders patterns, they either play out or they don't. Now, when they don't play out, they normally produce a move equal to what it would have produced on the downside. So what I'm saying is, if we somehow can recapture this trend line tomorrow and jump over it, or jump over it, then what you do is you're setting the market is setting up for a larger move to the upside. If tomorrow we open down, okay, and we open down and start closing the hourly, or even start trading convincingly below today's low here, which is 2046.75, then you're most likely going to start working your way down to the target, which would be 2000, which I didn't have in this this chart here. So let's label that. Okay. So and beyond 2000, I do have another calculation having nothing to do with the head and shoulders pattern at 1980, which I told you about last night. We're in a very, very interesting position in the market. We're either going to go significantly lower or significantly higher. And, well, you know, it's easy for me to say the market's either going to go up or down. What I am telling you is that the market is poised for a larger move, a larger directional move. And so here's the scenario. If we get a close hourly and then begin to trade significantly above this trend line here, higher prices are coming. If the market is weak tomorrow and we begin to break lower than today's lows, then I think it's going to play out down to the 2000 area. And that's not saying all tomorrow. That's just saying that would be the directional move for the foreseeable future in the next several days. Now, I believe that we're in a time period where we should see a market pivot higher. Okay, and I've been saying that. So I'm going to stay with that based on the fact that the market behaved according to plan today. We had the big down move. We had a pause day. This is in the window of a cycle turn. So I'm expecting higher prices. That's not to say the market's always going to do what I expect. It's going to do what it's going to do. I'm saying my work indicates higher prices, but as you know, we're not always right. But this is what I'm saying. This is what my work is telling me, higher prices. And I'm going to continue to go with my work because it certainly is more right than it's more wrong. But I have to give you both sides because it's not one of those scenarios where I can just say, buy the market, we're going higher. It's not going to work like that. We have to see evidence. But what I can tell you is tomorrow, if we begin to close hourly above this head and shoulders pattern and certainly close above it for the day, then that portends higher prices. No question in my mind, okay? If we can't get above this, if we rally up to this neckline and it fails, then we're probably going to go down to the target of the head and shoulders at about 2000. And that brings into play the 1980 that that has from a different calculation. Now, what does that mean for the slightly longer term, like into next week and beyond? Well, if we did come down to this area next week, that would probably be another buy area, okay? So it's kind of one of these. If we jump above the head and shoulders neckline, it's a buy. And if we go all the way down somehow next week, down to this green line here at about 1980, could overshoot by a few points, that's another buy. In between, it's somewhat in no man's land, and I recognize fully that this is a huge band. This is a wide area. But that's the position the market's in. I'm here to kind of give you balls and strikes. I can't rewrite the rules. I'm just going with what the market is telling us. And right now, the market's not going to tell me anything until we either recapture or fail or continue to fail at this head and shoulders neckline. And that's the best evidence I can tell you. And speaking of evidence, let's go over to some more evidence. Okay, let's see what else we have. Here's the IWM. Now, you'll remember this trend line I drew, and you could see what happens. Once we broke that trend line, it was lights out. But today was slightly better than the S&P in terms of the upside. So the S&P was up less than 0.5%, and the IWM was up more than 0.5%. It's not a whole lot, but it's something. It's something to not necessarily hang our hat on, but it's something to look to where to hang our hat, if that makes any sense. Okay, but you can see how important this trend line was. Once we blew this trend line, it was done. Okay, but we recaptured the 50-period moving average, closed on it today, which is slightly bullish. That's got to be with a bullish bias. Okay, there's one more piece of evidence that I want to show you before we move on to the other markets, which is the VIX. And what's interesting is the VIX. Now, I didn't talk about the VIX for the last few days, so you wouldn't know that I had a higher, about a $20 price target in the VIX, and we had a high today of $20. So that wasn't anything, to trade or hang our hat on either. So that's why I really didn't bring it up. But that's only on a daily chart basis. So that may or may not hold, and it may only hold for a day or two or three or four. We'll see. But the VIX was down about just slightly less than 5% today, and the market being only slightly positive by less than 0.5%. That's an indicator, right? That's some of that evidence I'm talking about that may portend higher prices. It's not a definitive anything. It's just one of those indicators I look at. I take note of it. I write it down. I watch it. I want to see how the VIX trades. If the VIX starts to trade higher and the market is kind of stalled out or slightly melting away tomorrow, I'm going to say that there may be trouble in the air. So that's one of the things that I look at just as an also-ran indicator for the next day or so. All right. I've given you everything I've got on the S&P. Let's go over to the gold market. And what a shocker. We closed the month. Okay, and we closed the month basically in the zone, right? I've been telling you 1174. We closed at 1172, give or take. Above 1170 has to be considered slightly bullish, not as bullish as I would have liked had we closed above 1174, but it's not going to make it easy, right? The market never makes it easy on us. I told you probably a week or 10 days ago that this market was going to close on the number, and it closed in the margin of error. When you're looking at an $1,174 market, and you close at $1,172, $2 off the number that I calculated, that's within the margin of error, right? It's pretty close. So what I would say is we need to see more evidence. If we see the market firm up on 1170, 1174, and begin to start to trade higher, I'm going to say that I think the low was in, and that I'm right, and that we're going to trade higher to 12 and a quarter or so. But I'm still not in the neighborhood or the camp that we can call a bottom yet, only because it's so close. Anything can happen. We can wake up tomorrow and gold could be at 1150. Who knows? So it's just we're going to have to see more evidence, and that's the best I can tell you. Even if I look at the hourly chart, I always do that. Look at the hourly chart, you'll see that we made a spike low today and reversed higher, and this is considered bullish behavior as long as you don't take out the low, which was 1165.40. Okay, so that's kind of slightly bullish. That's bullish behavior. That's erring on the side of bullish. I'm erring on the side of bullish, but I'm just not convinced that it's enough to buy the gold market yet, and that's where we are. I wish it was. I wish I could tell you more, but there's no way I can steer you into the gold market until we see more bullish behavior. So here's what that says, right? I mean, aggressive traders could buy the gold market, but here's what I would tell you. Until and unless we see more evidence that the market is making bullish behavior, and I can say, yeah, I'm 80% sure the market's going to make higher prices, I'm in the camp that I would rather make less money with more certainty that we're going to see the higher prices than have somewhat of a well, it kind of looks like we're there, so I'm going to buy it anyway. That's not 80% in my book. That just doesn't cut it. So that's kind of why I say I need to see more evidence, okay? I need to see more of a pattern. I really need to see this on a closing basis. I need to see 1176.30 taken out on an hourly closing basis for me to say there's more evidence, okay? You see all this market consolidation here. This is called market vibration. And when you see this, this is a meaningful area to the market also. You've really got to get above that area, and also this one. That's why I said last night, I said it's not going to just spike up there unless we see some wacky behavior out of Greece and the dollar and gold for that matter. But you're going to have to get above these levels, and it's not going to be easy. That's just the way it is. I wish I could tell you something easier, but the market doesn't necessarily always make it easy for us. Let's go over to oil. Oil was interesting today, okay? So here's the hourly, and you can see what happened. I left the hourly up on purpose because 59.30. Look what happened. Remember what I said, unless we capture 59.30 and begin to close hourly above 59.30, then, it's still bearish. And you can see what happened. We tried it, failed. We were above there for 2 hours today, and then we failed. And the fact that we failed tells me that it put the market in more of a bearish position. Let's go over to the daily chart. I always do that. That's not the daily. Sorry, folks. Okay, so you can see based on a daily chart, we spiked above the 59.30, failed, and I still think that as a result of failing, that we're probably going to see the 59.50 and possibly lower prices. And again, we're just in that area where I've got to see more evidence one way or the other. We're in no man's land, so it's a no trade in oil. But remember Friday, I was saying, make no mistake about it, all these markets are going to begin to clear up. It will begin to clear up. Gold is clearing up, right? Today was the end of the month. It's going to clear up real fast. Oil is going to clear up real fast. It's either going to go to the lower channel, the lower part of the channel, and it's going to either go beyond that, or it's going to bounce up higher, or it's going to close above 59.30 for the day, stay there, and then we're going to trade higher. So it's going to happen. We're going to clear these markets up one way or the other. It just doesn't necessarily do it on my time frame or yours for that matter, or anybody else's. Okay, bonds. Here's the TLT. Basically put in a pause day, came back into the 20-period moving average off the big up move yesterday, just short of the 382 retracement if you're counting retracements. That's pretty normal behavior after a big up move, just like the market, just like the stock market. Let's go back to that for a second just so I can say, this was a big down move. We retraced a part of the down move, and then we basically put in somewhat of a pause day, and that's normal market behavior, okay? So it's back to bonds. The bond market, again, is going to have to show us more, okay? It's got to show us more evidence that it wants to move higher or lower. You can't buy a market based on a one-day pullback after a big up move like this. You got to see it develop a pattern, a chart pattern, okay? So what we really want to see, if we're looking for higher prices, which I actually am, what we really have to see is we have to see more the market put in its time, right? It's time is more important than price. I have to see the market give me 2, 3, 4 more days of sideways movement that doesn't really give us more up or down. It's just basically sideways movement. And if we can see that and we continue to close above the low from yesterday, then I would tell you higher prices are at hand. But until we see a pattern develop, there's nothing to do. It's just that simple. That's just the way it works. Okay, let's go over to the dollar. I know I'm running through these markets a little fast today, but some of them just aren't telling us anything, and I'm not going to harp on the whole thing. We just have to wait for it to develop a pattern that gives us a trade. That's just the way it is. The dollar, kind of the same scenario. We put in that big reversal day yesterday, and what did it do? It put in somewhat of a pause day. It put in a little bit It certainly wasn't a reversal day, but it's certainly a bounce day, a retracement day. It retraced half the move. That's normal behavior. Okay, we need to see more. We need to see maybe the market puts in 2, 3, 4 sideways days like this, and then we could be setting up for another down move. We'll see. Okay, but as long as the market stays below yesterday's high, then there's lower prices coming. That's just the way it is. All right. And that's about it, folks. Oh, you know what else I want to talk about? I want to talk about natural gas, because natural gas on a daily basis, okay, pardon me, that's not natural. I knew that chart looked funny. That's not what I was looking for. That was copper. Natural gas is actually putting in bullish behavior, okay? Well, this is July. Bear with me. I'm sorry. Let me pause this. I'll get the right contract up for you. Okay, now we've got the right contract up, and you'll see that this is bullish behavior. And let me explain this from a daily chart perspective. Okay, you made a low. You rallied higher, and then you came back down to test the low, and then you put in a reversal off that low, and now you're making bullish consolidation. And if you remember what I just told you about all the other markets, when you make a big up move and then you go sideways, and the sideways move doesn't have to be 2, 3, 4 days like I've been saying. It could be 3 weeks. Okay, but the more sideways you go, and here's the deal. As long as you stay above this low here from the 9th of June, which was $2.74, or 2741 to be exact, as long as this market stays above that number, that's bullish behavior. It's building momentum to go higher. Okay, what do I tell you? Okay, ABC patterns, they happen all the time. ABC, or you can go ABC, okay? And C could be sideways. It could be ABC. I mean, there's so many variations. But what I'm suggesting is that the longer this goes sideways and stays above 2741, then the bias is certainly on the bullish side. Now, you've stayed above the 20-period moving average today. You're fighting the 50. Let's see, did you close above the 50? 50 is 283, and today's close was 283.5. It's funny how that works, isn't it? You see that? That's not an accident, folks. Okay, so the longer we go sideways, the more the probabilities increase. As long as we stay above this low, the more the probabilities increase that we see higher prices. And where would higher prices take us? Pardon me, it would take us back to these highs, okay? It would take us potentially back to 317 into the 200-period moving average. In fact, the longer we go sideways, the more chance you have to reach the 200-period moving average. Let's see the longer-term picture in natural gas, okay? The longer-term picture in natural gas is, can you get to the 50-period moving average on the weekly chart? Well, we'll see. We don't know that yet. That's remains to be seen. But what's this high here on the weekly basis? 316.3. That coincides with the 317 on the daily. You see how that works? It's just the markets are very, very symmetrical, and that's what we're looking for. So bullish behavior for those, and I know there's some of you out there that like to trade natural gas. So I'm looking at natural gas as a bullish market. I think we're going to give it a wrap there tonight. Hopefully this was helpful. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.